background on our organization, talk about our products and services, and ultimately highlight some of our customers who we've been able to assist with the help of many of our banking partners here in Colorado. So if I could please start with the first slide. With Colorado Enterprise Fund, we're a long-time CDFI. We were established in 1976. We're fortunate to work with great partners through the SBA, U.S. Department of Treasury, various foundations, and other nonprofits fund us as well. And we're also ARIS rated, which is a measurement of our industry of CDFIs that measure our community impact, our financial strength, and our performance. Next slide, please. As far as some of our organization background, we're a staff of 18 folks, 18 people. We've funded over $35 million since 1990 in our state. Last year, our fiscal year just ended. We closed just over 200 loans for $7.6 million. So that gives you an idea of the size of our loan fund. Our average size loan is in that micro loan category, approximately $35,000. And we currently service just over 400 loans. On average, we assist with 12 jobs for 2014, and our repayment rate is 98%. In terms of a profile of what we see as a micro lending in our state, we're seeing a lot of restaurants, breweries. We're seeing a lot of retail, food trucks, contractors. In terms of startups, we see 52% of our businesses as startups. 51% of those businesses that we close are women-owned, and 26% of our businesses are minority-owned. Next slide, please. Some of the programs that we offer revolve around healthy food initiatives. Right now is a big one for many CDFIs throughout the country. We currently are in partnership with what's called Colorado Fresh Food Financing Fund. That's a partnership through the Colorado Health Department, Colorado Housing and Finance Administration. The focus of this program is to really help food deserts or low-income, low-access areas that don't have access to fresh produce. And so we're looking to fund grocery retailers throughout our state in those food desert areas. Some of the other programs that we offer are flood relief programs. A couple years ago, we were impacted both in northern Colorado and southern Colorado with flooding, which affected a lot of businesses in that area. The SBA did some research and found that 1 out of 4 businesses affected by a natural disaster will end up having to close doors. So for us, it was important to have impact in those northern and southern areas by creating this relief loan fund, which was just a little more streamlined, a little less documentation for them, and hopefully enough to help them purchase the equipment or inventory that they may have lost through that issue. Other programs that we have currently are the Department of Transportation. We have funding directly to help contractors or the industry of construction that are working with the Department of Transportation. It's an industry that can be difficult to fund at times, and so we can do a lot of startup or existing businesses through that loan fund. The Pronto loan is a streamlined program for our micro-lending customers. We all know it can take a lot of time to do a small loan or a large loan. This allows us to work a little more efficiently and still have that targeted effort to our micro businesses here in our state. And lastly, we've brought on the SBA Community Advantage Program, which has really worked well for us. It's a strong program that allows us to work with businesses that are just short of qualifying with a bank, potentially on the collateral side, but still deserve good merit. So us as a CDFI, we're able to take a little more risk. We're looking at smaller loans there, anywhere from $100,000 up to $250,000 for that program. As far as how we've, next slide, please. As far as our use of funds, it's very standard, very general. We work a lot with our customers with working capital, equipment. They're purchasing into a business. If it's tenant improvements to a space or purchasing real, so very, very diverse, obviously, with the use of funds. Next slide, please. And our technical assistance is really key to our program, and we really feel this is the strength of and foundation of us as a microlender. So many of our clients are not bankable for many reasons, and it may be their credit or their collateral. As a microlender, we're going in there to try to support that client and help grow them so that they are becoming bankable. So with our business acceleration services, our customers are getting one-on-one consulting. We help them with QuickBooks and financial literacy. We'll purchase the program for them, send in our consultant to work with their business one-on-one, introduce them to the software, introduce them to how to do the entries, and then we'll monitor their progress throughout the life of the loan. The next point there is our business progress assessment. What's important there is it's a 27-point assessment that's reviewing various aspects of the business model. For the business owner, it's measuring their strengths and weaknesses. And between our consultants and the business, they'll decide what's priority in terms of improving and gradually, again, throughout the life of the loan, work on those different areas for opportunity. For consulting that is not within our sphere, we will work with our local SBDC or SCORE or other referral partners that are in our community. And overall, the services that we're providing in that is financial literacy. We're looking at marketing. We're looking at the management and the operations as well as some legal assistance. Next slide, please. And Dorothy, should I go into some of these examples now, or do you prefer that I hold off and
move forward.
Share it at a later time?
Move forward, Alan. Thank you.
Okay. All right. This first example is a local grocery retailer. We funded this last year with the help of a smaller community bank in Loveland, Colorado. Startup business. The project combined was just over $1 million, and the individuals brought a significant amount of their own capital injection. They were able to receive some crowdfunding as well. The community bank that we worked with was able to do a SBA loan, which we also did through our Community Advantage program. We filled a small gap of $153,000, which was essential towards the build-out and also some working capital. They just recently celebrated their 1-year anniversary, and so they are currently employing 18 individuals, 9 full-time employees, and are doing extremely well. So that's an example of how we've partnered up in a smaller community in Colorado, accessing both that grocery retail point and, again, partnering up with a community bank in that area. Next slide, please. This is a local deal here in Denver. It's Maria Empanada. The owner there that you see, her name is Lorena. She was an existing business in a not-so-visible area. The business had about 2 years history and was cash flowing positively, but was just getting by. They had an opportunity to move into a much more visible, dense area, and the local bank was not able to help them with the capital, mainly because of personal credit issues. And they were affected during the recession pretty negatively due to losing a job. Her husband had lost a job. The credit scores took a hit. Credit slowly took a hit. They had done what they well at paying off their collections and getting current again. And so with our loan fund, we're able, once a 6-month window of negative credit has occurred and we can begin to see positive trends, they are then eligible for our loan fund again. In this particular case, the negative was lower credit. However, we had good outside income. The collateral was very reasonable for what we were looking to provide them towards the equipment. They had good experience, a proven model, and the new location really made sense. So the banker really identifying that, look, it doesn't fit our box, but this should be a good deal for Colorado Enterprise Fund. We're grateful for and very glad that we were able to help with this loan. Since they've moved into this location recently, they've actually quadrupled sales. So they're doing extremely well in this new area. We already had 3 clients in that proximity, so we knew that it's an up-and-coming area. we knew that it's very good for this type of business model, and really glad that we were able to support that request as well. Next slide, please. So the last thing I'll leave you with as far as our benefits and how we try to contribute to small business here in our state, how we try to partner with different community banks, different SBDCs and SBA, is we have to be quick. You know, one way we try that is by being convenient and having an online application, on-site staff, and then providing that one-on-one attention to the customer when needed. Historically, we have over 38 years here in our state, so being fiscally responsible for that amount of time, having a long history of supporting small business in our state, and being a recognized name has also been key. But what I would ask you for all the banking institutions there today is to really consider where your decline clients are going. Instead of your personal bankers or your small business clients saying no, really considering, are there local CDFIs in our state that can help our customers and really continue that revolving door open so that they are growing, getting that working capital they need to continue, and ultimately being handed off to the bank for a great success story. So that's, I hope, a decent overview of how we're working with here in Colorado with many of our partners. And I hope that it's helpful, and happy to answer any questions as we move forward today.
Thank you so much, Alan. Great partnership there. Great work. I want to turn it over to Galen and let him talk to us a little bit about his programs and how he has those great results.
Alan, great presentation. In fact, at Justine Peterson, we very much have a parallel mission of the Colorado Enterprise Fund. So I'm Galen Gandolfi. A lot of people call me Justin Peterson, and I'll essentially answer to anything as long as it's not pejorative in nature. And I love my job. You know what my job is? This is in my more crass moments. This is what I tell people I do for a living. I make customers for banks. That's what I do. And that's how we empower people economically at Justine Peterson. I'm serious about that. So the Justine M. Peterson was a pioneer in advancing what we now call financial capability. And that is this idea of wedding financial literacy and education with products and services. And at Justine Peterson, we're all about the transaction. In fact, I try to explain that we help people by engaging in a lending transaction. It turns into a relationship, and it builds trust. We're all about graduating clients, customers to mainstream finance. In fact, Justine Peterson is a port of entry for mainstream finance. So very similar to the Colorado Enterprise Fund, we essentially want to create bankable credentials. We do a lot of credit building. In fact, we view the personal credit score the fundamental economic asset of an individual and that small business. So we do a lot of work in the credit building space. But it's this whole idea of graduating to mainstream finance, getting more competitive terms, providing safe and affordable capital. It's about access. This is probably not a politically correct analogy, but you know, we're like a fiscal or financial rehab program. We have a 12-step program to becoming bankable, and that's what we do. We've closed nearly 4,000 microloans. I've been personally involved in nearly 2,000 of those, been with the group 12 years. We've revolved $25 million. We're the nation's second largest microlender for the SBA, and we guarantee the money from the SBA. That is, we borrow as a nonprofit entity and then lend that money back to clients. There's not an SBA guarantee. Justine Peterson is essentially the guarantee. And I always let clients know that it's community money. When community member one pays their loan back, we take that money, recycle it, lend it out to the next community member. And in that sense, it does parallel international microfinance to the extent that people think they're in this thing collectively and that they can transform communities by coming together, repaying their loans, and allowing Justine Peterson to help the next business person. We started the Kansas City Regional Microloan Fund back in 2012. There were several years that KC in the area did not have a microlender. We were invited by a consortium of the FDIC, the Federal Reserve, several nonprofit practitioners, and we opened up shop. And since 2012, we've nearly lent $3 million in this market, nearly 300 microloans. Average loan size tends to be under $10,000. We cap out at $50,000, but we can go as low as just a few $100s in cap. And that lends me to think about payday lending. It's been mentioned a few times today. We combat payday lending head on. Average interest rate of a payday loan in the state of Missouri last quarter, I think, was something like 453%. It's just amazing. And you wouldn't believe how many established businesses are actually using payday lending operations for small, immediate cash needs. Sometimes they need to repair their delivery vehicle. Sometimes they need just merchandise, especially around the holidays. I grew up in a really small town. In fact, there was one bank. The bank president lived four doors down. He was on my paper route. And the vice president for the bank was my childhood friend's father. So I saw banking firsthand growing up. And I saw what it meant to build relationships. And like I said before, I love my job at Justin Peterson because all I do is bring bankers in the same room with small business people, start a conversation, and try to solve problems. And it's not always easy, I'll be honest. I mean, we're almost like the Statue of Liberty in terms of bring me your huddled masses and such, because there are some people who have abysmal credentials. But we have to start somewhere, building trust and building that bridge. And so the amazing thing is that the success stories are unabated. And in fact, demand, earlier there was a question about a raise of hands, about small business lending. Do you have demand? Do you not have demand? Demand at Justin Peterson is unabated. In fact, our capitalization efforts are we're always seeking to capitalize. We have about 15 local bank partners here in the Kansas City region. We have a total of about 25 banking partners. We, I think, fundraised nearly about $9 million in investments. Banks can obviously realize salient CRA benefit from making an investment into a CDFI, but there's also the opportunity of referrals. Maybe you don't have to say no to someone. And I'll be honest, we don't have the regulatory restrictions that many banks do. I mean, we're not completely autonomous, but we do have significant latitude in our underwriting decisions. Lend them money, build their credit scores, graduate them back to a bank. We also do participating loans, true gap financing. A bank can come in at some amount, and then perhaps we can come in at a smaller amount. I was a Boy Scout, so I talk about having a whittling knife. Many people come in asking for this. We whittle it down to a microloan and start building a relationship. Maybe 6 months later, 12 months later, lend them more money. That said, though, if they keep coming back to Justin Peterson, and we jokingly refer to them as repeat offenders, if they keep borrowing, then they're not graduating to mainstream finance, and we're not doing our job. We don't compete with banks. We partner with banks. And I shamelessly tell you that what I try to do is create customers for banks, because that's economic empowerment. V. Justine M. Peterson was a social worker. She was social worker of the year twice in the 80s. Our colleague, her colleague was Rob Borrell, who's our founder. When Justine passed, he christened this organization in her name, and we advanced that legacy of economic empowerment of building assets. And it's all about clients interfacing with mainstream financial institutions. So we're all about people building their credit scores, paying back their loans, and building assets. We're also a HUD-certified counseling agency in terms of home ownership and such. So it's always, to me, just a really, really, really dynamic experience to work with someone and to build trust and to finally get them through the doors of a bank. At Justin Peterson, when you walk through the door, we have to think about how we can say yes. Obviously, there are instances where we've said no, but we try to say yes. And when we say yes, we create opportunity, we build an active trade line, we build credit scores, and then we get them to a bank. So again, I think CDFIs, as Alan's presentation and with Sydney to follow here, there's an amazing partnership opportunity anywhere in America. There are micro-lending institutions and CDFIs everywhere, and banks should really consider about those partnerships and how far you can advance the economic well-being of your community at large by reaching out to small businesses and connecting them with CDFIs. One other thing I want to mention is this idea of greenlining and creating loan pools targeted for specific populations or geographies. Through our CDFI, banks can lend dollars and say, we want it lent in these zip codes, in this county, to essentially these individuals. And we can do that. It's essentially creating opportunity for underserved markets. And so if in fact there are opportunities for banks to consider such investments, they should reach out to a CDFI and explore those options. Recently, we created a small contractor and minority contractor loan pool in St. Louis. 4 banks have come together. We're having amazing success with that, and we're in discussions here in Kansas City about emulating that. So again, there's just so much opportunity that can be realized through the CDFI bank partnership. And again, the FDIC, I'll make a plug for the FDIC. You have a publication, a large publication, in fact, that details the opportunities that banks have to actually partner with CD5s.
Thank you, Galen.
All right. Well, good afternoon, everyone. I'm Sidney King. I'm the regional president with Liberty Bank's Kansas City operation. Liberty Bank is an African-American-owned institution, one of the largest African-American-owned institutions in the country. We started in the New Orleans area basically to serve a historically underserved community. That was the focus of getting the bank started, and we've expanded to 7 different markets, about to go into an eighth market now as we continue to push that mission of empowering the urban core primarily. But we are a bank for all people, let me say that. But from a traditional banking standpoint, when you look at micro lending, we've got limitations that we have to deal with. I don't know, back in the day, she mentioned I've got over 35 years of banking experience, and I think the gray hair kind of gives a lot of that away. But back in the day, we used a lot of judgment. Banking was a relationship industry. It was a relationship business. Somewhere along the line, credit scores came into play, and the credit scores kind of trumped pure natural judgment. When you look at a transaction now, a person comes in, that credit score is below 660, that's a subprime loan, we can't do anything with you. But in reality, those are the deals that create and empower our urban cores, our inner city communities. If we can support those businesses and help them get the financing that they need, they create jobs in those inner city areas. And when they create those jobs in those inner city areas, one of the key things it does, it keeps those idle minds off of the street corners and puts them in a position where they're doing something productive as opposed to destructive. So it's important to build within those urban communities. One of the things that we've talked about at Liberty is we build from the side streets. If we can help those side streets, put homeowners in those side streets, put businesses on those main streets that flow through those inner city communities, it will eventually build the economy back up because you're building from the bottom up as opposed to the top down. And so, we try to do things to work with the different businesses within those communities. For example, contractors. We've worked with some contractors. A lot of times your contractors, especially your smaller contractors, they don't have the financing. They don't have the knowledge, I guess. I don't want to say that they're not smart people, but they don't have the knowledge of the financial side of managing and operating their business. So they don't have good financial statements sometimes, but they're doing the work. Mm-hmm. And I think one of the biggest things from a banking standpoint, especially a community banking standpoint, is developing relationships, getting back to relationships with our customers. And I use an analogy about dating. When you first met your spouses, you dated. You got to know them. They got to know you. And as they got to know you, you eventually got to the point where you popped the question, said, let's get married. What a lot of times businesses will do, they'll come into the bank and pop the question with a loan application, as opposed to getting to know us. And in my opinion, I think we got a room full of bankers, and you'll probably agree with this one, the bankers are some of the smartest people you'll ever meet. No offense. And that's because we see so many business opportunities and so many business ideas. And we learn from working with those small businesses and what they're doing and what some of the pitfalls that they encounter and some of the opportunities that they may have. So getting to know us getting to know them, when it finally gets to the point where they're ready to make that question about this loan application, because we've had some input and growing that decision with them, we most likely will give them the answer that they desire, because we know how they're doing and we know that it's something that can potentially work, and we provide it where we can, a certain amount of advice to them. And I've seen it succeed many times. I've had customers that were in the T-shirt manufacturing business, doing football shirts, football season. They have a high need for finances at the beginning of the season, and then they sell those throughout the season. We've been able to come in and support some of those businesses and help them to get the funding that they need. But traditional banking, we wouldn't be able to do a lot of that because of the regulatory restrictions. We have a lot of regulatory restrictions, and we got to be able to justify the things that we do. And working with organizations like Justine Peterson and the other organization, the community groups, it does make a difference, because there are deals that for several reasons we can't do. Because if we did those deals, when the examiners come in, they will classify that, and we don't need those classifications. But working with an organization that can partner with us, it makes a difference for us. It helps those businesses to succeed and grow within our urban core communities. It helps the bank, as you say, graduate to a traditional banking. And I'm going to just kind of step aside for a minute. I heard the CRA comments that were being made. You know, for CRA standpoints, with a minority bank like a Liberty Bank, if you did a loan participation with us, you will get CRA credit for that. So if you have loan deals that you need to participate, you know, keep Liberty in mind. And I know you wanted to stay on track, stay on point.
Okay.
But, you know, given a lot of bankers, and I don't want to offend anybody with this statement, but did you know that everybody who's anybody banks at Liberty? You see, you have a choice when it comes to banking. You're at liberty to bank wherever you choose. So in that respect, everyone banks at Liberty. We just want you to choose Liberty Bank and Trust. But, and I do apologize, I have to throw my shameless plug in everywhere I go. That's what they pay me to do. I'm a marketer for the bank. But getting back on point, working with our urban core, you know, in our micro lending programs, Liberty has come up with some ideas, and we've tried to be a little, I don't necessarily say on the edge, but we got to work within the regulations because we got examiners here, and I don't want to say anything that gets us in trouble to have you come back and look at what but we've got a product. A lot of your, you know, startup businesses, smaller businesses, they go to the payday lending, title loan companies, getting their seed capital to get their business started. You know, in many instances, it works. You know, there are organizations that can help, but that's the mindset that they have taken. Liberty has come up with a product to fight those payday lenders, and we call it our Freedom Fast Loan. With that Freedom Fast Loan product, you can go online from the comfort of your home, get on your computer, go to our website, libertybank.net, fill out an application, and when that application is completed online, you have an answer within minutes whether the loan is approved or not. You know, if it's approved, a couple of other things to verify some information, that money can be in your account the next day. Now think about that. Why do people go to payday lenders? They don't understand delayed gratification. They got to have it now. With a product like that, it can help that person avoid getting caught in that pitfall. In our program, the highest interest rate is 22%, and that's for a person with a 550 credit score. You know, so we'll go down to a 550 credit score at 22% interest rate. That person really can't go into a traditional banking process and get approved. It just doesn't work. And it's primarily, you look at that person, you talk to that person, you can find out that that is a good business idea that they have. That's a person that is good, credit worthy, just had some challenges. Mm-hmm. You know, they just had some issues in the past. They may have had a donut hole issue that they went through. You know, medical issues, divorce, lost a job for a period of time. But basically, if you look at that person's credit score prior, it was great. You look at it afterwards, there's some challenges in that period of time, but since then they've been trying to reestablish. They didn't take the easy way out. They didn't go and file bankruptcy. That shows character. That person deserves a chance. And we've worked with those individuals and have been able to be successful in helping them grow their businesses. Now, in a former banking position I was in economies like this, we had a peer review come in and do a loan review for us. They determined that our loan loss reserve needed to be doubled. And we told them that that wasn't the case, because when you work with your customers and they get to know your community customers and they get to know you, in that particular case, our loss reserve, our past dues were in line with our peers. Our loss history, our charge-off history was half of our peers, but they felt we needed to double the loss reserve because of the economy, because of the traditional numbers that they look at when they look at those credit scores, because our average credit score at that time was probably about 600. You know, but when you work with the people, get to know the community, they get to know you, it makes a big difference in the community and it's from a lending standpoint. We got to get away from the standpoint of bring me that business plan. You know, once I look at that business plan, I don't want to talk to you until I see that. We got to talk to those customers and spend time with them, because it does make a difference in getting to know them and helping them get to know you and what your needs are from a banking standpoint, because putting those job-producing businesses on our inner city communities and our urban cores is going to make a difference for building this economy back. And that's really where the banking industry is supposed to be. We're supposed to be helping to build those communities and build not just build the net worth of the shareholders, but support the communities that we were created to serve. And that's where it all comes back. So
Thank
I
you.
rambled on a bit, and I'll stop and
Thank you for sharing your opportunities. I do have a question for you, Sydney. How are you promoting this product that you just talked about? And is it just a local product here in Kansas City? Or-
No, Liberty is headquartered in New Orleans. We are all over, we're in New Orleans, Baton Rouge, Jackson, Mississippi, Chicago, Detroit, Kansas City, Kansas, Kansas City, Missouri, and about to buy a bank in Alabama. So we are a growing institution that is serving, and we have loan production offices in Houston, Texas. So a growing institution getting to the urban core. But that is an online product. So anywhere around the country, if you go online to the Liberty Bank website, libertybank.net, that product is available to you. You click on that banner, fill out that application, and the funds can be in your bank the next day.
Dorothy, I appreciate you asking about promotion, because I want to say this. Justine Peterson's promotion budget for 2014 has been zero. 87% of our loans are word-of-mouth referrals. It's about personifying the transaction. It's about reinserting humanity in this banking process. And it's high touch. It really is. I mean, I still work long hours. In fact, I'll be meeting with a client in St. Louis this evening after I fly back. But it pays off. And I joke about I do house calls, similar to a doctor, right? And I have a little leather attaché, and instead of a stethoscope, I have a calculator and a notepad. We work out a budget and we solve the problem. Because the amazing thing is that pretty much is all math in the end. If someone's struggling with their loan payment, it's a mathematical issue to a certain extent that you can solve. And so be that modifying the loan or considering how you can reconfigure it. But again, it's this idea of relationships, putting a face on every transaction, and that graduates them. That builds trust in this idea of banking, and then introducing them to bank, real people, and who can actually, take them to the next level in terms of larger loan size, more competitive terms.
Mm-hmm.
Well, thank you for that. And thank you for, like I said, sharing your information with the audience here. But I have a question on partnerships and relationships. We have bankers obviously in the room. How do you create and establish those partnerships with your organizations? And I'm going to ask Alan to lead on this question, please, because I know that he's worked with a lot of community banks in regards to his projects. So can you elaborate a little bit on that for us, Alan? Thank you.
Yeah, as far as referrals go, just over 60% of our referrals come from banks. So it's the major source of how we're getting our leads. So it's important for us to reach out to our banks. We really try to reach out to initially to maybe a regional bank manager that's managing these small business bank specialists. We go into various banks and try to attend their banker meetings through their branch managers. It's important for us to really reach not only the small business bankers, but also those personal bankers that are really seeing some of these smaller micro loans. So for us, our loan officers are seeing at least 30 banks per month is what we're asking them to do, and it's a huge source of referrals for us.
Thank you.
And one of the things that we try to do is, and I think Galen made a statement earlier, we try not to say no. When we see a transaction come in, we can't approve every loan that comes in the door, but we will try to give some form of advice, and it may be referring them to an organization like yours that can help them and assist them with the idea that if we can keep that relationship, since they don't take deposits, we can get the deposits and keep that relationship, and as they grow and become more bankable, since we have that relationship, that business comes back to us.
Okay, thank you. Any comments?
Yeah, I think that's key. If I can just piggyback off that, is that the bank understands that there is no competition, that it really is the partnership of saying, let us fill the gap as they become bankable. So that's a big talking point for us when we're speaking to our bankers.
Thank you. So we want to probably open it up to some questions out in the audience. We have a great panel here that talked about a variety of things, specifically microloans and their products and their partnerships and relationships with our institutions. So I see that we have a streaming question in the back.
So from the streamers, so you're representing, Alan, you're representing Colorado, certainly Sydney with the states that you're in, and Galen. But what about for those states that you do not represent? So on our streaming audience, we have over 20 states represented. So the question is, how do I find CDFIs in my market? How do I find them as far as the ones that perhaps we can partner with a bank participation? So identifying CDFIs.
Sure. You go to the internet and you go to the Department of Treasury and you can find a whole list of CDFIs and you can find their service footprint. And you can contact me and I'm happy to make that introduction for you. So for the most part, there is CDFI coverage throughout the 50 states. There are some CDFI deserts, if you will, but there are also some national CDFIs that have complete coverage of the entire nation. So again, I'm more than happy to assist with that, but I also feel that that information can be easily had through the internet.
Yes.
Yeah, I think if you Google micro lending, you can find a lot of the institutions that provide the micro lending. I actually did that before it came, and Justine Peterson, I think, was number 2 or 3.
I think another option also is the Opportunity Finance Network is an organization. It's a member-based organization for CDFIs. And so Opportunity Finance Network is a website where you can also find a long list of CDFIs.
Do you have any more questions out in the audience? Another question?
I have some questions here. Oh, did you? Oh, on this one. Just to make sure that folks, some of the lenders here have not worked with CDFIs, and I think it came out through all 3 of the presentations as far as that you're not competing with financial institutions for those bankable deals. But again, is there, Galen, perhaps if you could share, I know that Alan shared an example or 2 examples of where you had community banks involved in a partnership. Galen, any examples? Is that kind of Justine Peterson's model as well, to working with financial institutions in a partnership, or are you just straight out micro lenders, you do the deal?
No, not at all. I mean, there's countless examples of, participating loans, and there's actually examples of where an existing bank client, the bank's not in a position, they have a lending history with that client, but they're not in a position to do an additional loan request. And so we've been able to step in, do that, and then ultimately refinance that potentially down the road with the bank. So again, it's all about partnerships. And so many of, as Alan also mentioned, so many of our referrals come from banking partners.
Mm-hmm. Mm-hmm. And it's important from a banking standpoint, to find an alternative for your customers. As I mentioned earlier, if you can help them develop the financing that they need because you've been involved with that, one, there's a loyalty that when they graduate and come back, they're coming back to you. But the other side also is you have an opportunity for the deposits and any other type of financing needs that they may have.
Mm-hmm. Thank you. We need to take another question from the audience.
And Dorothy, I'd also like to know from the audience, has anyone worked on a participation with CDFIs by show of hands? Okay.
I have a question for Sydney. I'm quite familiar with Liberty Bank. Some things I don't know, for example, the ownership, that kind of thing. And what I'm curious about is if it's I think at least that's privately held. And so how does one, most people when they start a business, they're profit motivated, and I'm sure Liberty's profitable, and that's something that you all are concerned about. But how does one motivate like an ownership structure or management structure to orient themselves towards fulfilling the needs of underserved populations as a kind of either a primary or a secondary motive for the business you're doing?
Well, fulfilling the needs of the underserved population, I kind of commented earlier, when we look at what's going on in this economy, there is so much distress or destruction going on in our community because we're dividing between the haves and the have-nots, to an extent. that have-not community could do a lot more productive side of the community if there were opportunities there, because that's basically what they're looking for is opportunities. What we've done is our focus has been primarily serving that underserved community, and we have been a very profitable institution. There's financing there, there's money there to be made in serving that community. There are needs to be needs to be met, and if you do it properly in that community, it can be profitable. You know, we're not a nonprofit organization, we are a for-profit entity. And we're working in that urban core, which is a community that a lot of places look at as saying there is no money there, but there's profitability in that community if the deals are done right. An example is the church lending industry. You know, years ago, that was the bread and butter of the minority banks, lending to the churches in those communities. When the other banks saw that that was a profitable market, they started coming in and doing those deals, and were very successful with it. You know, so there's money to be made in the urban core, in the inner city community, but just getting in and doing it right. Don't just go in and do it just, you know, from a social standpoint. It can be done profitably, and you can be successful in serving that community, and it helps the economy and the country as a whole.
Thank you. Another question that I have in terms of relationships. FDIC, what we do in community affairs is we leverage relationships between community organizations and nonprofits, and we have various initiatives that come down from Washington. And we work with our bankers, of course, and other organizations to leverage that relationship. But my question is in the micro lending side. The average small business person that comes in to get a loan that has bad credit, can you tell me, Galen, the requirements for your microloan?
Sure. So, I mean, we look at the 5 C's as well, except we have latitude on those. And that is, I'm glad you're all sitting down because this is radical, and that is we don't have a minimum credit score. I mean, we go beyond that. And so if someone's coming in with their house free and clear, then we could potentially look at significant collateral compensation. So it's about distilling that scenario to some loan that we feel comfortable with. We have to mitigate risk, you know, and
Yes.
obviously. And we do, you know, we do prudent underwriting. So not everyone is approved, nor is everyone receiving a loan size that they request. But again, it's this idea of how can we potentially say yes to some loan amount that could solve some problem. We also know that some loan amount could be too small for the issue. And in that case, maybe we can't solve the problem entirely. But again, this idea of lending, making some lending transaction the first step in building a relationship.
Good. Thank you.
You commented about bad credit. I mean, when you look at it, is it a low credit score or a discipline issue where they just don't pay anybody? The person with a low credit score, we may be able to help them if there is that donut hole instance that took place, you know, the job loss, the divorce, or, you know, illness, things like that affected them. But if they've got a discipline history, there's nothing we can do for them. That's a person that is just not going to pay you. You know, they'll come up with a reason, but they're still not going to pay you. If there's a discipline issue, and you can see that on that credit report. You know, a person filed bankruptcy 7 years ago or 3 years ago, and now they already got delinquent credit. That's a discipline problem.
So is it a financial education training attached to your program that you have?
Yeah, yes. You know, we try to do financial education, and I think there's a big need for that in the community, but just getting the people to come to the events. And I think one of the challenges is they don't want people to think they have financial issues, so they don't show up. But we've got to find ways to get them to get that education, you know, where they can come and get the information to help somebody else.
All right, well, we want to conclude this panel, but we want to take this opportunity to thank them for doing a great job. Thank you.
All right, thank you so much. Quick announcement. So for the streamers that are joining us via stream, we're going to be taking a quick break for lunch. So we will be resuming the streaming session at 12:45 Central Time. Again, streaming resumes at 12:45 Central Time. Thank you so much. We look forward to having you join us for the regulatory discussion. Now for the audience here.
to learn more about the Federal Reserve. Over the last 100 years, the Federal Reserve has carried out very important functions to support the United States economy. During the time that you're here, you will learn more about those functions, and you will see how the Federal Reserve is changing along with our economy. I hope you enjoy your visit today.
Well, central banks around the world differ somewhat in their mission, but the one mission that is common to all is the responsibility for the financial stability of a country and the monetary policy of the country.
It protects our monetary system and tries to make sure that we don't have these high spikes in unemployment and interest rates so that business can compete.
The founding people who thought up how the system would work were brilliant.
The Federal Reserve Bank of Kansas City is the regional headquarters of the nation's central bank. It participates in the conduct of monetary policy. It helps ensure the safety and soundness of the banking system. And it provides financial services to commercial banks and the United States Treasury. The Federal Reserve Bank is perhaps the world's most unique central bank. Unique in that it's not just one bank, but 12 established throughout the country. This extraordinary banking structure hasn't been around as long as you might think. In fact, before the Federal Reserve was formed in 1913, the U.S. twice attempted a central bank, but each time, those banks didn't last.
Central banking began with the start of the country. It was Alexander Hamilton's dream that we have a central bank in the United States, and he proposed one when he became Secretary of the Treasury. But from the founding of our country, there has always been controversy over a central bank and the integrity of the currency and who controls the currency and so forth.
The first Bank of the United States was headquartered in Philadelphia and had branches nationwide. Its purpose was to stabilize the nation's economy by providing a standard currency, establishing a credit system, and regulating state banks. But for many Americans, the bank held too much sway over the economy, with excessive influence from northern financial powers. So when the 20-year charter expired, the bank's renewal failed in Congress. It was about that time that the U.S. once again faced England during the War of 1812. The economy struggled as the nation tried to financially support the military. But by 1816, President James Madison, who once opposed central banking, called for a second central bank to ease the country's fiscal woes.
And so there was one chartered, second Bank of the United States with a 20-year charter. Now, the one thing about each of these first two banks was that each was a monolithic organization, a central bank, a single bank, did have branches. And so when the second bank actually came up for renewal again, the Congress this time was prepared to renew the charter.
But by the 1830s, President Andrew Jackson was in charge. He believed that the national bank was still too much of a monopoly, with the financial power in the hands of only a few men. His attack was publicly supported, and when the bank's charter expired in 1836, Jackson vetoed its renewal.
Following that, the country did go into financial withdrawal. We had a recession, but we still did not recharter it. In fact, we went through the rest of the 19th century without a central bank of the United States.
After years of continuing financial panics, Congress created the Federal Reserve in 1913 to bring financial stability to the nation. The legislation, signed by President Woodrow Wilson, created a unique central bank with a decentralized structure.
Each regional bank is managed by a local board of directors, including 6 who are elected by the bankers in that district. The regional banks are then monitored by the 7 members of the Federal Reserve Board of Governors in Washington, D.C., who are appointed by the President and confirmed by the Senate.
With the legislation approved, officials then wrestled with the question of how many banks were needed and where they would be located.
And so the Federal Reserve Act created a group called the Reserve Bank Organizing Committee. And they were charged with determining the boundaries of these districts and the locations of the Reserve Bank cities.
The organizing committee was composed of the Secretary of Treasury, William McAdoo, Secretary of Agriculture, David Houston, and the Comptroller of Currency. That position was slated for John Skelton Williams, but his appointment was tied up in the Senate. So the immediate tasks fell to McAdoo and Houston.
That drew some preliminary maps, did some research. They also sent out a ballot to the national banks across the country and asked them basically, where do you want your reserve bank to be?
And almost every big city at the time wanted to have a Federal Reserve Bank because it was a sign of maturity, and they knew that that would attract commerce and banking.
To determine these 12 districts, the men decided to tour the country to learn about the existing business relationships in each area. In 5 weeks, they visited 18 cities and heard from 37 communities. They began their tour in the Northeast with visits to New York and Boston.
The initial list did not include Kansas City. Great hue and cry went up here among bankers and business leaders in Kansas City, and they organized both locally and with their national representatives. We had at that time, of course, a congressman from the 5th District, William Borland, but we also had one of the 2 Missouri senators, James A. Reed, a former mayor of Kansas City. Efforts were going forth on all of those levels to push for at least getting the organizing committee to make a stop.
So what was it about Kansas City that warranted a Federal Reserve Bank?
In the heart of our nation, a natural network of river, road, and rail extends from one point, Kansas City. This promising town was an enviable crossroads for industry, business, and banking, especially for the southwest corner of the United States. By 1913, the 2 largest mail-order companies, Sears Roebuck and Montgomery Ward, had huge distribution centers here. 1,200 manufacturing companies were also headquartered in Kansas City, employing over 40,000 residents. As a center for agriculture, Kansas City companies lead the nation in sales of farm implements and in lumber sales of yellow pine. The famed Kansas City stockyards were the busiest in the nation, second only to Chicago. Those 60 acres were trampled by the millions of hooves from cattle, sheep, horses, and pigs. Adjacent to the stockyards were the rail yards, where 2,000 freight cars rolled in and out of the city every day. To better handle the rail traffic and replace the much-flooded Union Depot, the Union Station was nearing completion. When it opened in 1914, Union Station promised to be the nation's 3rd largest train station, whisking nearly 260 passenger trains to and from the city. Kansas City's optimism reflected the grandiosity of the new train station, for it was built for a metropolis of 1 million or more residents, nearly 4 times the current city's population. Kansas City, definitely a town on the move.
William McAdoo and David Houston arrived in Kansas City on January 23, 1914. They were to meet with representatives at the Federal Building on Grand.
Newspaper accounts from that day say there was a crowd of about 2,000 there that actually spilled out of the building into the street to welcome the committee.
What the Kansas City Committee did was to bring in people representing all kinds of economic activity that flowed through Kansas City. So you had, for example, the treasurer of the Atchison, Topeka, and Santa Fe Railway, who was not headquartered in Kansas City, but rather in Topeka. Representing the Oklahoma interests, there were 2 gentlemen from Bartlesville, one of whom was by the name of Frank Phillips. All of these people were testifying on behalf of their particular segment of industry that this was a key place to be.
One of the most interesting things about the Kansas City hearing was the level of regional cooperation that existed. This was truly very much a bi-state effort. In fact, the sitting Kansas governor and his immediate predecessor both addressed the committee in favor of Reserve Bank in Kansas City, Missouri. Now, this type of regional cooperation did not happen in other places. If you go to sort of comparable situations of neighboring cities, Minneapolis and St. Paul both fought very bitterly for a Reserve Bank. Fort Worth and Dallas both fought very bitterly for a Reserve Bank. Really, nowhere else in the country did you see this kind of regional cooperation that went on in Kansas City that day.
On April 2, 1914, 4 months after beginning their 10,000-mile journey across the country, with 5,000 pages of testimony in hand, the organizing committee announced the 12 reserve cities: Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Dallas, San Francisco, and in the heart of the country, Kansas City, which celebrated its selection as the 10th district.
They had what they called a jollification meeting, which is essentially a big party. This was attended by the city's bankers and business leaders. They brought in some vaudeville-like entertainers. There were 3 hours worth of speeches by local bankers and business leaders. William Kemper from Commerce got up in front of the group, was asked to speak, and he said, "I don't want to talk, I want to sing." That tells you a little bit about how everyone felt about the city winning the Reserve Bank.
The bank's board of directors met for the first time on October 16, 1914, under the leadership of Josiah Miller, Jr. There was a rush to open the banks to prevent a possible financial panic due to the unfolding war in Europe. Miller and his board had a lot to do.
They were on an incredibly tight timeline. They held their first meeting on October 16th of 1914, and the Federal Reserve banks would open on November 16th of 1914.
Kansas City bank officials expected a relatively quiet grand opening, but it turned out otherwise. The bank received more than 500 letters and telegrams, along with flowers and plants from throughout the region. The United States Federal Reserve Bank was now up and running and ready to take on the nation's newest crisis.
Never before has warfare been conducted on such a tremendous scale.
They had quite a challenge, of course, during the time of World War I, because that meant that a great deal more money was flowing through the bank, and its role increased dramatically.
The bank also had a prominent role in helping finance the First World War with the Liberty Bond campaign. These were a series of campaigns used to encourage folks to buy bonds to help fund the battle. The Federal Reserve Bank of Kansas City was the leader in the 10th district.
For its efforts, the bank was rewarded with a German 10.5-centimeter light field howitzer captured by the U.S. 35th Division on October 1918 in the Meuse-Argonne, the last major battle of the war. The gun is now on display at the National World War I Museum in Kansas City, Missouri.
So once the dust had settled a little, the public began clamoring for the regional banks to open up their branch banks.
Under public pressure, Congress made the appropriate amendments to the Reserve Act, and 4 branches opened in 1917, one of which was the Omaha branch of the Kansas City Bank. Kansas City's second branch opened in Denver the following year. The Oklahoma City branch opened in August of 1920. Once the branches were open, Josiah Miller Jr. turned his attention to finding a permanent home for the Kansas City Bank. After scouring the city, the board chose to buy the land across the street from the Long Building on the northeast corner of 10th and Grand. Construction began in 1920. In less than a year, and after spending only $4.5 million, the building was complete. And by November 1921, employees moved into their offices, which offered every modern feature of the time. The Federal Reserve Bank of Kansas City moved in 2008 to an even more secure, more modern facility at 1 Memorial Drive, where it can better deal with today's financial issues.
The Federal Reserve Bank has experienced changes over time. Perhaps the most notable came during the Great Depression of the 1930s, which led to the creation of the closely watched Federal Open Market Committee to set the nation's monetary policy. Although the bank has continued to adapt to an evolving banking and economic landscape, the central bank's focus remains on providing the financial stability sought by its founders.
They really thought through the role of a central bank, and they really thought through how the central bank supports the economic vitality of the country.
The bank's structure also remains unchanged. The 12 regional banks are as important to the system today as they were in 1914.
So I think that they bring regional perspective even now, even in this much nationalized country and much larger political body. I think they bring a regional perspective that's important at times.
Instead of having just the West Coast or the East Coast make decisions for the rest of this country, I think that would be unhealthy because they only have part of the story, we have the rest of the story.
The United States continues to be the most important economy in the world. Doesn't mean there aren't other important economies, but we are certainly an industrial power and will be, I think, so through this century. To do that, you have to have a financial system that is second to none, and we do, but it won't be if you take it for granted, so you have to be thinking forward. You have to be thinking about how transactions will be conducted in the future. And you have to be responsive to the institutions that are there. We still have a very important community banking system. It's thousands of banks that are responsive to the consumer as well as businesses, and you have to have a central banking system that supports that infrastructure, and that's what we are prepared to do.
Even though our mission and responsibilities have remained unchanged, the way we carry those out have had to change. And so as we look to the future, I expect that those trends will continue. We will continue to be challenged to adapt and change the way we do business. And in fact, we are changing even as we speak today.
The Federal Reserve is a unique central bank. Its design reflects the value Americans place on spreading responsibility broadly across the country. It's a system that has served the nation for a century and is prepared to continue serving us for generations to come.
set it on your lap. I think we're good to go.
Panel at this point. So good afternoon. I'm delighted to be your moderator for the regulatory panel. My name is Michael Martinez, and I'm a community affairs officer with the Office of the Comptroller of the Currency. Before I introduce our panelists, I wanted to take just a moment to highlight some resources that are available to you on many of the topics that were covered today. So for example, we heard from a number of community development financial institutions, or CDFIs, and our most recent publication is entitled Community Development Loan Funds, Partnership Opportunities for Banks. This is a publication that highlights the myriad ways banks can partner with CDFIs to satisfy their CRA and community development appetites, as well as to increase profitability. In addition to that publication, we also have a number of publications related to the SBA, USDA, and the State Small Business Credit Initiative on our website. So in the spirit of the green thrust that we have today, all of the materials that I just cited can be accessed off of occ.gov. Once there, click on the Community Affairs section, and there you'll find all of our publications as well as other useful tools and resources that you may find fruitful. Okay, so as Ariel indicated on the onset and has repeated a couple of times during the morning, we really hope to make this panel as interactive as possible. And as such, we received some questions on the 3x5 index cards that you were asked to write your questions on. But I also want to encourage you, for those both present and streaming, to ask questions on the topics at hand if you didn't get an opportunity to write them down. Let me go ahead and introduce the panel. I'm very pleased to have a very seasoned panel of examiners with us today. To my left is Jim Bothwell, and Jim's a bank examiner with the Federal Reserve Bank's Kansas City branch. Jim serves as the central point of contact for 16 community banks and their related holding companies, all located within Kansas and Missouri. Next to Jim is Doug Pittman. Doug is the Assistant Deputy Comptroller with the Office of the Comptroller of the Currency, and is responsible for our Overland Park field office. In this capacity, Doug supervises 25 national banks and federal thrifts. One interesting note is prior to becoming the Assistant Deputy Comptroller, Doug was the Office of Thrift Supervision's field manager responsible for examinations and supervisions for savings and loans institutions and holding companies located in some surrounding geographies. And then anchoring the panel is John Pankratz. John has been with the FDIC for 24 years and a supervisory examiner for the last 11, all of them here in the Kansas City field office. John has extensive experience in dealing with more complex banks. Okay, just to get the panel going, we heard a lot of information earlier today from our presenters, and now the question is for the banks, so what does that mean to us during an exam? Or that may be one of the questions you may have. I'm going to go ahead and start the questions, and I'll ask the question to nobody in particular, but if all of you have a response, feel free to respond, and hopefully we'll have a discussion and dialogue similar to some of the other earlier panels. So, when you review a bank's portfolio, how do you look at the loans with credit enhancements? Are they fundamentally different from a conventional loan? And can you give us an example of your take on that?
Well, I mean, I don't believe that we particularly target any particular loan just because there's a guarantee or anything like that. I mean, most of the community banks have probably one or two SBA loans. I mean, I think there was few people raising their hands. I think we want to do more of a kind of a macro approach, or just kind of does the bank understand what programs they're involved in. I mean, we deal with a lot of rural banks that probably have FSA-type guarantees, or banks in the city with SBA guarantees. And on occasion, you might see the USDA guarantees, but we probably just ask questions in terms of what why they're involved, what they're doing, and how that benefits the bank.
Does any of the other regulators view that any differently, or?
I don't see it any differently. I would agree. We don't really treat credit enhancements any differently. We're looking at the safety and soundness of the credit.
To a degree, if a credit is showing a well-defined weakness, it's usually the SBA that is not adversely classified. So credit enhancements are, in the end, viewed a little bit differently. So from my perspective, the credit enhancement enhances the credit, but we don't look at the underlying repayment terms any differently. I mean, we still look at cash flow, we still look at collateral, we still look at guarantees. But if the credit does have a well-defined weakness, it's that credit enhancement that usually precludes an adverse classification for that.
So it sounds like when you go into a bank, if you see a loan with an enhancement versus a conventional loan, it's essentially a loan that you're looking at, and really kind of looking at it from that perspective, as opposed to the urban legend that somehow examiners come in and look at these programs and loans with a jaundiced eye, but that doesn't sound like what I'm hearing today on the panel.
I mean, I don't believe so. I mean, I guess bankers always probably think when we ask a lot of questions, maybe we're questioning why they're doing that. But that's not really our intent. I mean, it's the bank overall, and how that fits into their program and their knowledge of the situation. I mean, obviously, if that loan hits in our sample and it's a guaranteed loan, I mean, it's going to take a little bit of extra work, just looking at the documents and confirming with the bank that all the appropriate documents are signed so that the guarantee is effective, so that when they report on their call report or factored into their allowance or the classification, that it gets treated appropriately. I mean, in any problem loan, if it's got the guarantee, there's always going to be the question, have you documented it appropriately to capture that guarantee?
Great. Anything else to add? Okay. If you go into a bank and a bank president asks you or is considering using some of these programs, before deciding to do it, what kind of questions should she be asking? And what would be the strengths and weaknesses of exploring adding that to the loans, to the bank's services and products?
Well, I would offer up that, they want to assess whether they have the expertise. Do they understand the program, first of all? And do they have the in-house expertise to evaluate, underwrite, and originate and service those particular assets within that program?
That sounds sensible to me. I mean, anything else, any other advice you might provide this bank president?
No, I'll just piggyback off that. I think that the president should be first ensuring that the credit culture within the organization is appropriate for direct loans, and just parlay that into an SBA guarantee. And to me, there's a little higher level of due diligence with that type of enhancement. So you need to make sure that whatever program that you have in place, that there's some level of quality control or audit that is behind that program, just to make sure that loan officers are following protocol and the processes that have been put in place to protect the institution.
I would agree with John.
Okay, great. Doug, anything else to add?
No, I don't believe so.
Okay. Well, let me move to one of the 3x5 index cards questions that cropped up. I'm not sure this one can be answered. It's a little out of the wheelhouse, but this is related to the Fed and interest rate and the interest rate increase. Anybody want to weigh in on what the outlook of that is, when, how much, and what the economic effect will be on that?
That's a few floors up from where I work.
Okay, a few floors up. I did want to ask the question simply because we did encourage folks to write your questions down. We may not have all the answers, obviously. This one sounds like it's a few floors up. Anybody else want to have a crystal ball, want to weigh in on that? I didn't think so. Okay. As an examiner, you get inside lots of different lending institutions, and I'm sure each one handles these credit enhancements slightly different. For example, there are different levels of centralization of processing and servicing. In your experience, is there one model over another that works particularly well?
I think that's a hard one to answer because the banks vary so much. I mean, a lot of that's going to depend on the size and amount of volume that the bank, actually participates. I know we have one member bank here in the Kansas City area that does an extensive amount of SBA lending and has a substantial amount of staff and expertise allocated to that. But I believe there's, a lot of community bankers that wear a lot of hats, so it's kind of hard to have, a whole separate department.
Yeah, I think it's very difficult to just make a blanket statement that this works better than the other. It really gets back, and maybe I can just touch on our sampling process. I mean, part of the reason we select 20 to 30, 35% of the loans to look at is not only to do some transaction testing, but to really evaluate the program as a whole. What is the protocol for underwriting? What is it for credit administration? What is it for risk rating or credit review? And so, it's not a one-size-fits-all. And so examiners go in and they're tasked with trying to find out how you, as the banker, administer those three programs. Is it effective? Are there recommendations to further enhance it? But it's really the lending culture of the institution that needs to be assessed.
That's very well put.
Okay. So it sounds like every institution is a little bit different, and there's flexibility and autonomy for banks to kind of fashion their own program based on its culture and the customer needs that it may have. When you go into a bank and take a sample of loans to examine, do you make any concerted effort to seek out USDA or SBA loans or any of these that were using the state small business credit initiative, or is the sample random and then whatever's in there you all are looking at?
Well, we all probably use somewhat similar, but obviously different approaches. We have a product that does some statistical sampling. The EIC and the person that's doing the loan review is supposed to, read through some of the board minutes and committee minutes and kind of assess what initiatives are going on at the bank. I would say if, you jumped into a new area and added a whole bunch of SBA loans, then we probably would add it to our sample, but it's not part of our normal protocol.
That hold true for the rest of the
I would
regulators
agree with
as
that.
well?
We typically go in, random sampling. We do, the EIC or the LPM certainly has the ability to expand that into a judgmental sample if they want to.
And I would say a bank with a well-established SBA program, we probably go to an extent to eliminate most of those. Because when you take away the guarantee, the risk to the institution is rather small. Whereas you take a direct loan, the potential risk to the institution is much greater. So we probably spend more time looking at direct obligations than we would an SBA credit. But on the other hand, if a bank established an SBA program within the last 12 months or since the last regulatory examination, we would want to maybe increase our sample size of those SBAs and just take a look. Again, we're trying to assess the program here, and while we do that, there is still an element of transaction testing that goes on.
So you touched a little bit upon the guarantee portion of some of these enhanced loans. This is a way for some banks to generate fee income. The premiums on secondary market sales for government guaranteed loans can be quite generous. So if a lender sells that guaranteed portion on the secondary market, but maintains or retains the non-guaranteed portion on the balance sheet and continues to service the loan, will this affect the loan from a safety and soundness perspective? And will you view the loan differently at that point?
I mean, I guess you'd have the unguaranteed portion on your books, like I think John alluded to. Usually that's a smaller amount. So it, typically our sampling weights in a lot of the larger loans and the larger risks to the bank. I mean, I guess it would depend on kind of the volume of that activity on the bank's books, and then maybe we'd have to kind of do a target on that particular area. I guess I think maybe the bigger question we may want to know is if the bank's profiting from the sale of those loans, and they're retaining the risky ones, what are they doing with those profits? I mean, is it all going out the door, or are they allocating a portion of that to the reserve because, you're maintaining the risky part on your balance sheet, so you better be retaining some of those profits to cover those potential losses, because you're not going to have the interest off the guaranteed portion, or are they putting it into capital or something like that?
Yeah, I would want to get a comfort level on the risk rating of those credits. That's probably what I would want to focus on, is if you started to pull a sample and they were past credits yet had some well-defined weaknesses, we'd probably want to pursue that a little bit more and try to beef up that review program. But if those credits are being risk rated properly, I would have an indifferent approach.
Doug, do you see it any different?
No, not really. I would agree with both those perspectives. The only thing I would offer is, it's kind of like eating your dinner for breakfast when you do that. And most of the problems that I've heard of with that particular program of selling the guaranteed portion has been that those have been the banks that have encountered problems in that type of an area. Once they sell that, they've lost that protection, and those loans sometimes aren't as well underwritten, or the quality isn't what it was, certainly, when it had that credit enhancement. So they have to be very careful, understand what they really have on their books once they sell that.
Right.
I think another thing would be, if a bank went down that strategy, is we'd want to look at their servicing. I mean, because, just like with the home loan situation when the crisis hit, I mean, the buybacks and the risk there, if you're selling all the, guaranteed portion, but maintaining all the unguaranteed, but you still have that servicing responsibility, we're going to want to make sure you're adequately staffed and managing that responsibility and don't have a lot of putbacks. Otherwise, there's substantial risk to the bank.
So in other words, I mean, it's just the more you talk, the more I feel like you're looking at this in the same way that you would look at any loan when you went into a bank to kind of do the safety and soundness review of that particular institution. I'm going to go ahead and ask another question that came up on the 3x5 card. I can tell that our audience is very keenly interested in the future. This question reads, what's the general outlook for the next 24 to 36 months of commercial and real estate development, specifically multifamily product? And how is this message being relayed to member financial institutions? I'm not sure that's a question you can answer, but it was asked and I thought I would throw it out there.
What you're seeing. I think you need to talk to the Fed's economic department probably, but we're seeing a lot of growth in the OCC in our banks, especially on the West Coast in the multifamily area. There's been a lot of activity there with respect to that. If that's going to continue for the next 12, 24 months, it's anybody's call, I guess. But prospects are pretty strong right now with respect to that particular product.
I guess every market's a little bit different. How about the market here in Kansas City, Missouri, or Kansas?
Well, you sure see a lot of apartments and multifamily construction going on. I'm not certain who's doing all the financing for those projects, but just the numbers itself supports that loan growth is coming back into our community banks, and so from that perspective, it's good. I just don't know if it's multifamily or how long multifamily is going to stay. Single family too, you see a lot more single family construction today than what you did 4 years ago. So some of these real estate markets are coming back to our community banks.
Yeah, I would concur with John. I mean, I think it's obviously improving, or not seeing any deterioration like we were.
Okay, great, thank you. I'm going to pause for just a moment and check in to see if we have any questions coming in streaming, or if anybody has a burning question that they'd like to ask the panel at this point. You can always preface your question with, I know a bank that does it like this, if that would be helpful.
So for the panel,
please.
Basically asking in regards to knowledge of the program. So we've been covering quite a few programs here, USDA, SBA, SSBCI, CDFI participation, those kinds of things. How much is enough as far as, to address the risk? How much knowledge is sufficient, let's say, to participate and to have that as part of the lending program that a financial institution adopts?
Well, regulators, there's never enough, right? No, I don't know. I mean, I think it's just a comfort level with your conversation with the banker in terms of that they understand the program and communicating that to us, because the crews don't see, very few people have actually made the loan. You've made that type of loan. If you can explain it to us, it helps us understand what's going on with the actual credit.
I think one of the big issues there is that you need to have the knowledge of what your responsibilities are to ensure that you maintain that guarantee, because that's a contingent liability on your books. And if you don't follow through with the requirements to maintain that guarantee, then you're going to lose it or it'll be challenged when you have to make a claim.
Okay.
Yeah, I'd agree.
John?
I'd agree with what both of them said.
Okay. Was there another question, streamer? While we're waiting for that question, just to piggyback off of that, in your view, is too much or too high a concentration of government guaranteed lending at any specific institution an issue or a problem?
I'm not aware of any particular situation.
No, I'm not aware of any particular situation, although I'd say that we would probably look with a critical eye at any significant concentration, whether it's guaranteed or not, because as I said, unless their program is, unless we're ensured that their program is such that they're maintaining that guarantee, they're doing what they need to ensure that that guarantee is in place on an ongoing basis. There's that contingent liability there, and whether you have that guarantee or not, it could go away.
Right.
Yeah, and I would talk more about looking at the concentration risk underneath the guarantee, not the guarantee itself. Are you in a particular industry that you're using guarantees to protect or to enhance? But I think from the last crisis, we all learned that concentration risk needs to be continually evaluated and continually monitored. And if concentration risk elevates, higher capital should be, afforded management so they can operate the way they should. And so I guess my response to that is just maybe broader, that concentration risk should always be a concern, but it's what you do with it and how you manage and monitor it.
You want to add anything?
No.
Okay. Going back to the streaming question.
All right. So what kind of due diligence do you expect to see on participation loans? So as far as in working with the partners. So again, what kind of due diligence do you expect to see on participation loans? And then there's a second question tied to that. So I don't know if you want to just tackle that one first and then I'll ask the second.
I mean, I think the message we try to relay is if it's a participation, you better underwrite it like you would underwrite something of your own and know all the circumstances and not rely on the other party just to portray what the credit is. You have to understand it yourself.
So there's a level of due diligence that the bank has a responsibility for, even though they're partnering with another entity that may be strong, but it's still part of the bank's acumen to go in and actually do some of that due diligence and underwriting. Any different response to that at all, or anything to add to that?
No, I don't think so.
Okay.
That says it.
Please.
So the second one was kind of in regards to, and ties into that, issues that you see. So when there have been problems at a financial institution, what are perhaps some of the common missteps that have been taken, and perhaps some quick fixes or things that perhaps should have been in place as they're considering their lending program?
Well, if we're talking about SBA, I haven't seen any firsthand problems with that. So it's our community banks, especially in this part of the country, if they're active in SBA lending, it's only on a very small scale. So they may have 2, 3, 4, half dozen SBA loans, and that's pretty much it. You have to get into the larger institutions before we see that type of volume that has led to the problems.
Okay.
If the question is broader in scope as to, the issues that we deal with loan participations, I think if you have a small position, you typically have a small voice, and you're pretty well bound by the consensus of the group. And so it's never a short-term fix when a loan participation goes bad. You're in it for the long haul. And I think that's what's important about doing proper due diligence up front. There's nothing wrong with loan participations. You just need to be prepared and understand not only the strengths of the credit, but also understand the weaknesses and the potential weaknesses of that credit when it's underwritten. But again, if you have a small position, you typically have a small voice in the matter.
I'm going to do a check with the audience again. Are there any questions for the regulator panel at this point? Okay.
I might just voice on that question about problems, and maybe I'm just trying to reach back in my memory of maybe an SBA situation that seemed to be a problem. I mean, the credit was already probably classified at the bank, and I think there's always issues, bankers worrying about getting paid on the guarantee. I think a particular instance I can recall is, the borrower was probably going down somewhere. They got a guarantee subsequent through some kind of refinance or some sort of thing. There was probably already weaknesses evident in the borrower. So, I'm not sure all that was correctly portrayed in the application, to the SBA. And then the borrower eventually goes under, and then there's lots of questions about, collection on that. A lot of that kind of falls back on the bank from the beginning, or the couple banks that were involved. If it's a bad deal, it's a bad deal. It's not really the SBA's fault they don't pay out on their guarantee.
Anything else to add? Anybody?
I think the SBA speaker talked about the one-offs, and we probably all have examples of where an SBA loan went bad, and that's the one we use to illustrate our points. But it usually just ignores the thousands that were paid out without issue and so forth. But part of the due diligence, I did run across one SBA application where the loan officer check never been past due, and submitted it through. And then when you actually go and do the research, this borrower was past due a lot. So, proper due diligence in filling out that application, just, you fill it out correctly, and that's going to assure that many heartaches down the road won't occur. So I just share that story because it's just a one-off. I don't see that in every institution I go into, but it was one where maybe a little harmless, it pays as agreed, but then you go look at the history and they're 31 days past due frequently.
We're probably as guilty as as the examiners, we operate into the negative issues because that's what our job is. So we see the one-offs, and that's why we ask a lot of questions when we do see, your loan, even the good SBA loans is, we've seen some of those things happen. So we're just trying to, pass on what we've seen elsewhere. And hopefully that benefits the bank, even though it may come across as we're questioning the guarantee on that.
Okay. Any other questions from the streamers? Yeah, please.
So in regards to, for the panel, as far as best practices, and I think FDIC just covered a few, but from each of the panelists as far as best practices for banks that are utilizing some of these programs.
I would say just be thorough in how you underwrite these credits, and just as you would a direct credit. Knowing where the disbursements are going, and does it conform to the SBA's or whoever's doing the guarantee, does it conform to their provisions and their rules, and was the timing? And so to me, that's the first step. You need to know the timing and the disbursements and who they went to, and that should be documented very clearly in the file. Second, when you get into credit administration, make sure that there's fresh eyes on that document to make sure that collateral is protected and that insurance is up to date, and all the things that you would expect your loan officers to do with a direct loan. And then follow that up with a credit review program that actually stresses the risk grade to that credit. Is it properly risk graded? Does it factor in not only historical cash flow, but prospective cash flow? And really, to me, it's quite simple. It's what you guys do very well with direct lending. You apply that to the SBA, but you've got paperwork that's involved.
I would just add that maybe if you're getting into the SBA, particular with the CDCs that they have. In a prior life, I did sit on the other side of the desk and worked on a couple SBAs, and I found the CDCs to be very helpful in putting the package together, given my own familiarity with all the forms and processes. So.
Okay. Those are both very good answers, and the only thing I would add is that earlier today there was some discussion on the SBA's credit scoring model.
Right.
And I know that the OCC has reviewed that, and our position is that the bank needs to have the documentation in their credit file to support the repayment capacity of the borrower as well as the lending decision that was made.
Okay, so that's in addition to then, just to make sure that there's ability to repay that. Have any of you been involved in a merger or acquisition, institutions that either have merged or acquired or acquired another institution?
I have not.
Been part of that?
I worked at a bank where we acquired some banks, but I don't think there was really any SBA loans involved in that.
Okay. On that note, then, let's hypothetically look at a situation that a bank is either merger or acquiring another institution. In that instance, would their credit enhancement portfolio be handled any differently than their conventional book of business? Or would it present any unforeseen difficulties, or is there anything to be concerned about in a situation like that?
Well, I think they want to make sure they do their due diligence and ensure that the bank that they're buying or they're merging with or acquiring was performing under the requirements of the contracts for those credit enhancements, to make sure that they are still in place, or they will continue to still be in place.
So that should be
called upon.
Sorry, Doug, but so that's part of their process then when they're looking at either merging or acquiring with an institution on the front end, then would it?
That's
right?
what I'd expect, yes.
Yeah, I would expect the acquirer to do more due diligence, but from a regulator's standpoint, I don't see it any different as far as what we would look at in a merger transaction.
Okay. Any questions from the audience? Any streaming questions?
And Michael, this isn't actually a streaming question, but as far as we've seen, and you brought it up through mergers, acquisitions, and so forth, but tied to that often are staffing transitions, so that perhaps you had at Bank A someone that was very accustomed to the USDA B&I program. They're now gone. May not have, the person that comes in that's as strong on that program. From a regulatory standpoint, again, is that the information and knowledge of the product? Is that a concern? Is there a practice there that banks can have in place when they've had those staffing transitions?
That's a good question. I think management succession is always a big issue. You could have a direct portfolio that's complex and you could lose a loan officer or key knowledge source, and you would be faced with the same dilemma. I don't think SBA or USDA would require a higher level of due diligence other than it should be incorporated into any management succession plan. If you lose key people, what are you going to do? How are you going to react to it?
I would agree.
You know, I'm very pleased that we're having this discussion up here, because I was a little concerned that if I asked a question, every one of them was going to say, it depends, it depends, it depends. So we didn't get that. I'm going to go to the cards that were written and see if I can find one that may be germane to the panel today. I'm not sure I'm reading this correctly, so if I misread this, if the person who wrote it is brave enough to stand up and correct me, that would be a good thing. And this question reads, it's kind of a comment and then a question. SBA loans and similar loans tend to be loans that a bank was not able to make conventionally. How do the regulators look at these loans in classification purposes when there is some deterioration or weakness in the loan? If the answer is no differently than any other loan, then is there a discussion around lax underwriting standards for classification to encourage more small business lending? Not sure I asked that correctly. Sounds like they're asking, though, in order to encourage more small business opportunity within the bank, can they consider, and if I don't have this wrong, please speak up, can they consider looking at these, underwriting these a little differently than maybe some of their other normal or conventional loans?
I'll take this one. It depends.
Well, I think I think we view the enhancement as positive, and that allows the bank to stretch some of their terms. I mean, I think the loan still needs to be able to repay itself, but you know, if it lets you go out 7 years on equipment or something versus 5, or you know, the 504 is a great program. You know, if it lets you stretch out your amortization, maybe you wouldn't normally go out 25 years, but you're the first with the SBA behind you. I think we'd view that as positive, and with the enhancement that protects your risk on that deal, given the change in terms.
Okay.
What was the second half of that question?
Well, if I read it correctly, if you're looking at these loans no differently, the enhancement, government enhancement loans no differently than any other loan, is there a discussion to lax these standards for classification to encourage more small business lending?
I don't think that there's been any discussion at the regulatory level that I'm aware of with regard to that. But.
Well, I'll just add that, you know, when we adversely classify a credit, it has to meet our definition of substandard, doubtful, or loss, or special mention. So it has to have a well-defined weakness. So really there is no way that we could treat SBA's guaranteed loans differently than a direct loan, with the exception in nearly all the cases, unless there is documentation that the SBA has refused payment, that guaranteed portion should be passed. So I guess that is a way of helping, or at least addressing the second part of the question, is the lax standards. You're not being punished or penalized for that guaranteed portion. It is not adversely classified.
Okay. Any questions from the audience? Are there any streaming questions? Okay. Well, there's a lot of reasons why banks engage in this kind of activity, either with SBA or USDA or some of the other government enhanced programs that are out there, partnering with community development financial institutions. Some of them include increasing the bank's commercial loan portfolio, managing legal lending limits. The 504 program was mentioned a couple of times. In those instances, the CDC portion of the 504 doesn't count against the bank's legal lending limit. It also sometimes is used to help manage credit risk and liquidity management, among other reasons. There's a whole host of reasons why banks engage in this. Generate fee income. Clearly, there's some CRA consideration in some of these lending programs. So I don't want to sit up here with the panel and kind of arbitrarily or artificially come up with questions just to maintain, the agenda and get out of here on time. In fact, it probably wouldn't hurt your feelings if we got out a little early today. But what I heard from the panels today with regards to the government enhanced programs is a number of things. One is to be very clear as a bank why you're doing this type of lending, or if you're not doing it now and want to venture into it, why you think that's a good idea. Making sure, and please panel, if there's any additional comments that I might have missed that you highlighted during our session, please let us know. But the other thing that I thought I heard was really making sure that the bank understands the program fully, what's required of the bank and vis-a-vis those programs. And in that regard, kind of understand both the intended as well as the unintended consequences of getting into this kind of program. Be thorough on the underwriting, have a system in place where there's file review, just very similar to a bank's normal business. There was mention of management succession, which I thought was interesting, and to me, that was kind of a comment that related to capacity within the bank to be able to handle this. Oftentimes, there's a designated lender within the bank that is doing this particular type of programming who really understands the programming a lot. But most importantly, I guess what I thought I heard, and let me know if I'm wrong, is that on the whole, these government enhanced programs are really not viewed from a supervisory point of view any different than the bank's direct lending. And I think that's an important point because we continue to hear this urban legend that somehow they are different. And I think it can impede banks from really looking more closely at these type of programs to help do some of the things that I had mentioned earlier, manage credit risk, generate fee income, CRA considerations, et cetera. Is there anything more that I might have missed while you were making your comments that you would add to what I just stated in trying to summarize the panel this afternoon?
I'd just say if you're going to get into this, I mean, like, I'm a central point of contact. I would hope, you let your contact, whether it's the case manager or the FDIC or whatever, just kind of know, what you're doing. If it's a new strategy, I mean, not just a one credit deal, but if it's an avenue you're pursuing to generate revenue or more business given these economic conditions.
Yeah, I would say we frequently encourage our bankers to pursue these routes, to do guarantees when, when it fits the situation. And so we're definitely not adverse to these. And risk-based capital, they get better treatment, and there's a lot of advantages doing guaranteed loans.
Doug, any final comments?
I would just say that I don't think the SBA programs are any different than any new product or service that a bank might get into. We would expect you to pursue that with the same diligence as you would any new product. Make sure you have the expertise on board to address it. You have the capacity to deal with it and the knowledge, and certainly keep your regulator aware of what you're doing.
Perfect. That's great advice. And just to be clear, even though we've been talking a lot about SBA, we're really talking about government enhanced programs that include USDA, some of the other presenters that we're presenting today, including the SSBCI programs, et cetera. Will you join me in thanking our regulator panel, Jim, Doug, and John? At this point, I'm going to invite Ariel back up for some closing comments and to move us to adjournment.
All right, great. Thanks so much. Will you guys join me in thanking this panel and all of our presenters today, please? All right, so we've covered a lot of information today, and we've had it confirmed in some cases from the regulatory panel. At this time, if you go back to your pocket folder and look, we have an evaluation in everybody's folder. This is an important tool. And for those of you that are streaming, you're going to be receiving the evaluation at 2:15 Central Time. So we've already had it planned. So you're going to be receiving that 2:15. If you wouldn't mind, while you're looking at that, one of the things I'd love for you to focus on is action. What action are you going to take? Can you take? And if you could tell us some stories, perhaps, are there some opportunities that you can see where you might be able to use USDA RD, the B&I, or SBA 7A 504, or SSBCI, or an opportunity with a CDFI to leverage funding. I mean, perhaps there's some deals that are coming to mind right now where it isn't appropriate for conventional, for your market rate product, but that you might need a partnership. I'd love to hear about that and what that means, because again, and maybe the action is you're going to share it with your team leads, perhaps, your managers over lending or some of the other folks. Perhaps you're going to share it with your president of the organization. But tell us as far as some of the action that you're going to take, hopefully within the next few days, or the next month, what have you, that you can incorporate this information, because ultimately the sessions that we conduct, the webinars, the place-based events, the materials that we produce, it's for not if it's not applied, if there's not any action that's taken with that information. So if you wouldn't mind doing that, and as I said, for the streamers that are joining us, you'll be receiving that at 2:15 Central Time, if you wouldn't mind completing that. So that's an automated system there. Let me just, I had mentioned some tools as well that we have on our website to make it easier for you, your financial institution, as you're going through the various resources and so forth. So I know that many of you are probably part of your economic development council or committees within either your county, your city, or your state. We have a product, it's called Grow Your Own, that one of my colleagues developed here at the Federal Reserve, and we have the link for that. So it's a tool to assist communities as they're working to build and grow their communities. So we're going to provide you with that link. It's on the website, so you can find Grow Your Own, whole host of resources, webinars, guides, etc. And I hope that you'll share it with your economic development colleagues, because you're part of that picture as far as the financial institutions that are in the community. Next is CDERG. I know Galen mentioned the CDFI fund as far as for CDFIs and how to identify them. CDERG is the Community Development Investment Resource Guide that we developed. And one of the weaknesses, I guess, of the CDFI fund, which they know, is that it basically identifies where a CDFI is located, but it doesn't necessarily give their entire coverage area. So if you look, for example, in some of the states, what have you, it may not mention all of the CDFIs that cover that area. It just shows where they're based. So CDERG is a searchable database that we've developed. So basically you input the state that you're in, and it'll identify those CDFIs for you, and then you can break it down. It gives you the what that CDFI does. Certainly some of them do community facilities, small business, affordable housing, and so forth. So again, another resource for you to make sure you take advantage of that. And again, this is to leverage, a tool that you can leverage, and again, to mitigate risk. So that's on the broader community side. Also, I wanted to introduce you to a couple of products that can help you with your businesses, the folks that you're working with. So one is putting your paycheck to work. That was developed by one of my colleagues as well, to assist the employees of those businesses that you are funding. So again, if you can help, and this is kind of a value add, to assist those employees, those business owners that are hiring. And remember, we have new employees that come on board that often don't realize what a paycheck may look like, what everything is as far as the taxes and so forth that are taken out. So that's another one, putting your paycheck to work. Lastly, P3, disaster preparedness, which is, you actually have it included in your packet on the left side. This was a new tool that we developed to assist small businesses and also households to recover from disaster. So this is, again, as we view it, as an opportunity to help with addressing risk that might be out there. And I can't remember who covered the number as far as 1 out of 4 businesses do not recover post-disaster. So what if you're lending to that organization, to that business? That's the one. What's going to happen to that loan and so forth? So again, it's another tool that's available to assist the business and to also assist households in your area. So those are the various tools there. Let me see what else I had in my notes. All right, so I've covered that. Those are all on our website. Let me again thank our colleagues at the OCC and the FDIC. I'd also like to thank my colleagues at the Federal Reserve. There's a lot of folks that are part of this effort. I'm not sure if you noticed at the very back whole desk of computers and so forth with Stacy Montague and Mary Izan, and there's Justin and Lawrence. And anyway, a lot of players that are involved in this, and Estelle Jean in Denver that has been a part of it, a lot of players that have put this together. So thank you so much for joining us today. Please fill out the evaluation that helps us know what you thought about this session, how you're going to implement some of these programs, and also to tell us about future programming, because we are talking about 2015, and what are some of the gaps, informational gaps that you have, and how can we assist you, how can we assist your communities. So with that, we are adjourned. Thank you so much for joining us today.